The biggest risk to the United States economy was never the AI bubble. It was never China. And it was never the man sitting in the Oval Office. It's something much more boring, and that's exactly why nobody is paying attention. Because if you've been wondering why mortgage rates refuse to fall, why stocks randomly panic every few months, and why the Federal Reserve talks about cutting rates, but everything still feels tight, the answer doesn't start in Washington. It starts in Tokyo, and more specifically, in the most boring asset on earth: Japanese government bonds. Because the country known for anime and tourists has quietly been holding the global financial system together for decades. And that system is starting to crack. But to understand why this matters, you have to go back. Japan. The early 1990s. An asset bubble bursts. Real estate collapses. Stocks collapse. And Japan enters something strange. A decades-long economic freeze. No real growth. No inflation. No wage growth. It was like the economy hit pause. So the Bank of Japan did what every central bank does when it runs out of options. It cut interest rates to zero, then below zero. And when that wasn't enough, they took control of the bond market, capping long-term yields, locking rates in place for decades. So Japanese government bonds paid almost nothing, and that created a problem. Because if you are a pension fund, a bank, or an insurance company, you can't survive on zero returns, so you face a choice: accept nothing, or go somewhere else. They chose somewhere else, and that decision changed everything. Japan became the largest foreign buyer of US debt, one of the biggest buyers of mortgage securities, and eventually, the world's largest creditor. Japan became the world's ATM. Not by choice, by math. Here is how it worked. Bob borrows money in Japan. At near zero interest, he converts it into dollars and buys us bonds yielding 4%. After costs, he keeps the difference. Simple, low risk, free money. This became known as the yen carry trade, and it didn't stop at bonds. Investors bought stocks, real estate, emerging markets, anything yielding more than zero, for years. This became a massive source of global liquidity. Trillions of dollars flowed through this system. It was like markets were running on Japanese Wi-Fi. But everything depended on one assumption: that Japanese rates would stay near zero forever. In 2024, that assumption broke. Japan raised rates, then raised them again, and markets reacted instantly. Stocks dropped. Volatility spiked. Because when Japanese rates rise, everything changes. Borrowing gets expensive. Hedging gets expensive. And the free money trade stops being free. That 4% return, not so attractive anymore. And when the math changes, the money moves. Capital flows back to Japan. This is called repatriation, and it's one of the biggest hidden risks today. Because for decades, Japan wasn't just a buyer. It was a consistent buyer, a reliable buyer. And when that buyer steps back, something breaks, because long-term rates aren't controlled by the Federal Reserve. They're controlled by supply and demand. And if demand weakens, yields rise, even if the Fed cuts rates, which creates a strange situation. Short-term rates fall, but long-term rates stay high. So mortgage rates stay high. Housing stays expensive, and financial conditions stay tight. But it doesn't stop there, because long-term rates are the foundation of everything. Stock valuations, corporate borrowing, economic growth. When those rates stay high, everything slows down. Stocks trade lower, companies borrow less, growth weakens, because money itself becomes expensive. And here is the truth. For 30 years, the global economy ran on one idea: cheap money from Japan. But that era is ending. And when liquidity disappears, markets don't just slow down, they struggle to breathe. Because liquidity is the oxygen of markets. And when it tightens, everything feels it. From stocks, to housing, to the entire economy. And yet, almost nobody is talking about it. Because it's not exciting, it doesn't trend, it doesn't go viral. But that's exactly what makes it dangerous. Because the biggest risks in markets are never the loud ones. They're the quiet ones, the ones hiding in plain sight. If you want to understand how money really moves, subscribe for more.